Hey, thanks everybody for joining us. We'll talk about Trident Royalties. I'm Adam Davidson, the CEO. This is the same presentation that's on our website, so I won't read you the disclaimer now, but you can read it at your leisure. So Trident Royalties, we're listed on the AIM exchange. We're a mining royalty company, listed just about 3.5 years ago. At that point in time, we listed at 20p a share. We had secured one royalty on an iron ore asset in Australia. If you fast forward to today, we've grown the portfolio. We now have 21 assets across lithium, copper, gold, iron ore, a little bit of mineral sands and some silver. And 13 of those assets are cash flowing, and then actively looking to continue to broaden the diversification of the portfolio. But let me take a step back and talk about royalties as instruments. I think for many investors, they've invested in mining equities. So these are the actual mining companies that are exploiting the deposits and selling the metals or minerals. In the case of a royalty, it's not hugely dissimilar from what you may be familiar with a music royalty or a film royalty, whereby the artist gets paid when there's revenue from their work effectively. So if you sell an album, the artist gets a percentage of that sale. Well, it's not dissimilar with a mining royalty, where we've got a royalty over a given property, and when they produce material and sell it, we get a fixed percentage of their revenue. So what exactly does that mean for us, and how does it differentiate us from investing in mining companies themselves? A couple key things. One is we're directly leveraged to the commodity price. So in an environment like we're in today, gold has sort of skyrocketed past $2,000 an ounce. If you've got a royalty over a gold property, you'd be in a pretty good position because you're getting a cut of their revenue, so the top line of their profit and loss. Whereas if you're invested in a gold miner, you would hope that they'd be outperforming in this kind of environment, but that's obviously not a guarantee. What can happen is costs are also rising as well. We're in an inflationary environment, obviously, so the inputs to produce that ounce of gold are rising. Labor, diesel. Diesel, for example, is circa 15% of most mine site costs. So when you tally that up, what you may find is that although the metal prices have moved in the right direction, profit margins actually might be tighter for the actual operator. So we're not exposed to that style of exposure. If the metal price goes up and we're just getting a cut of their revenue, then it's as simple as our percentage of our royalty times their production times the price at which they're selling their material. So importantly, we're protected from operating costs and capital costs. In as much as if the mine becomes economic and shuts down, obviously the revenue ceases and we no longer clip our portion of their revenue. But outside of that, as long as the mine continues to operate, if their costs rise and they're making a 1% profit margin, that doesn't impact us whatsoever as the royalty holder. We're getting our fixed percentage of their revenue. Importantly, though, we still get the exploration and growth upside of the asset. If people wanted only metals exposure, then they can invest in physical commodity ETFs or other instruments that give them exposure to gold or copper or iron or whatever they want exposure to. The reason people invest in mining equities is because 80+% of all mines that are built either extend their lives or expand their planned production profile, and you get that asset level outperformance. We get that exposure with the royalty because our royalty is over a given property, it's over a mine. So if they extend their mine life, then that revenue line item of their P&L gets extended and we get exposure to that. So it's got this sort of sweet spot overlap whereby you're getting that direct commodity level exposure, but you're doing so via a very protected instrument that hedges you away from the operating costs and the capital costs, but still gives you that asset level exposure. And it's a little difficult to read on the slide, but what you can see here is the gold miners index relative to the big three gold-focused royalty companies, and they've universally outperformed gold equities. In fact, I think almost all royalty companies have outperformed mining equities. So the big differentiator then is what is Trident doing different? And that's what we summarize here, which is we're not the only royalty company in the mining sector. The top donut chart here flags that by revenue, and you can use just about any metric, but by revenue, the mining sector is roughly a third precious metals, so gold, silver, roughly a third base metals, so copper, nickel, zinc, and then roughly a third bulk commodities like iron ore, and increasingly battery minerals. And yet the mining royalty sector, this lower donut chart, is 90+% gold focused. So it's not a tiny sector. It's in aggregate, sort of 80+ billion in aggregate market cap, the mining royalty sector, and yet very, very heavily weighted towards precious metals. A couple reasons for that. The largest one being that this model, the royalty model, was founded in North America and largely used to help finance precious metals mines. And it's really grown over the last 20 years, where 25 years ago, there really weren't any royalty companies in existence. You fast forward to today, as I said, 80 billion in aggregate market cap. So you had the first few that were very successful in the early 2000s. A sort of next iteration came in the 2010s, and they were also very successful. And I suppose what we've tried in strategy is that in the sector, you've got of the 80 billion in aggregate market cap, 75+ billion of that's focused in precious metals. And as I said, precious metals is less than a third of the entirety of the mining sector. So in that mining royalty sector, you've got one $30 billion precious metals focused royalty company. Why there's not a $50, $60 billion diversified mining royalty company that does precious metals, but also does copper and nickel and zinc and iron ore. Why that's not yet in existence felt like a real dislocation in the sector. And in fact, that was the genesis from my personal perspective. Getting involved in Trident and launching the vehicle was, I previously worked for a mining private equity fund. We do equity investments and mezz debt investments, and it wasn't uncommon to tack on a royalty as a bit of a return kicker. We were a closed-end fund, so we had a fixed fund life. And what we found was when we went to sell, in my particular case, it was a mineral sands royalty in Australia, was producing, was generating cash flow, was a relatively small ticket size, and we couldn't find a buyer for that asset. Obviously, the gold royalty companies didn't want a mineral sands royalty, although it was cash flowing in a good jurisdiction. And the handful of diversified mining royalty companies, it was too small to sort of fit within their mandate. And that just seemed like a natural dislocation. So that was really the genesis from my personal perspective. And we launched the vehicle 3.5 years ago. As I mentioned, had secured one cash flowing iron ore royalty. And I think most people that hear the strategy sort of think that sounds very intuitive. Why has nobody done this before? The question we got in the early days was, are there actually that many royalties out there to be acquired to generate critical mass? And hopefully we've gone some way to answering that. Obviously good to show a share price chart that despite tapering here in the last couple of months, listed at 20p and up sort of 60% since IPO. But the more important thing about this slide is the annotation of the transactions we've done to date. So we've done about 15 transactions over a total of 21 assets. So hopefully we're through that proof of concept phase such that we can demonstrate these royalties are out there to be acquired. Both existing royalties, the miners generate quite a few royalties themselves. They'll often swap assets and sell assets and do M&A. And as they're doing so, it's not uncommon for them to retain a royalty on an asset they've just sold as a bit of sort of protection. If they've just sold the next mega mine, they've still got some residual exposure. But what you tend to find is these things sit off balance sheet, so they get no attributable value for them. And ultimately, they'll hit a cycle where we're in today, where share prices are off, and they'll look to monetize these assets. So many of our transactions have been from mining companies themselves that have royalties on properties that they don't actually own anymore, or from private individuals that have generated royalties through pegging ground and selling properties and that sort of thing. And then, of course, the other aspect is we can provide financing directly to the mining companies. Again, an environment like we're in today is an ideal time to do this. Even if projects are moving in the right direction, markets are soft, share prices are down. So mining management teams who would, in a normal market, go and raise equity to move their projects forward, they're now finding that that's incredibly dilutive, so they're open to royalty financing. So for us, it's an ideal market to get out there, acquire royalties, and continue to build out the portfolio. Just briefly, this shows the smattering of our assets across the global map. Two things to flag. One is that 60+% of our net asset value is in the US, Canada, and Australia. We obviously want to be in tier 1 jurisdictions. We will go further afield to find returns. We'll price in jurisdictional risk, but we want to keep that proportionality. We don't want to become a frontier markets offering necessarily. The other thing to flag is on the other side, we show our select royalty partners. These are the operators of the assets. I think oftentimes there can be a misconception that because we're a junior royalty company that all of our royalties are on junior-owned projects and therefore are higher risk projects, swing producers that would go out of production when metals prices soften. when in fact it's almost the exact opposite that's true with our portfolio. The bulk of our assets are held by good mid-tier companies, so strong balance sheets. As you can imagine, that's an important part of our due diligence process when we're looking to acquire royalties. So the likes of Lithium Americas is a couple billion market cap, Equinox Gold, similar, Victoria's 500 million, Minres 10 billion. So these operators are good, well-funded companies that can see themselves through the cycles. This one might be a little hard to read, but this shows our revenue profile. Can't stress enough that this is the profile we built in the little over 3 years that we've been listed. So we started with one single cash flowing royalty that we'd secured, which is now about 2% of our overall net asset value, and have built it out aggressively since that time. The key thing to flag on here is sort of the darker blue part of the bar graph are from assets that are currently cash flowing today. So they're in production, they're paying us our royalties. And you can see our revenue from those assets that are in production actually increases sort of 50 to 60% over the next several years. A couple reasons from this. There are 13 assets that comprise that dark blue area. Quite a few of them are either in ramp up in terms of their scaling their production or they're undergoing expansions. So that's a very secure source of growth. And then the light blue section is from assets that are by and large are in construction today. So we've got a slew of assets where their first production is a little more opaque in terms of start date. But the growth that we're showing on this screen, because I'm sure you all see many equity presentations where they show revenue growth that's moving up and to the right. We feel like ours is very tangible, and that's either from assets that are currently producing or assets that are actually in construction as we speak and are slated to turn on in the next several years. With regards to commodity diversification, you can see on the side, this is the analyst consensus estimates of our net asset value by commodity. So roughly 40% lithium, 30% gold, 20% copper, and then the balance is in silver, iron ore, and mineral sands. I suppose the important thing for us to flag here really is the objective is to build out a broad, diversified portfolio of exposure to the sector. So many investors, myself included, have invested in the mining space, and you're sort of faced with a challenging prospect. You can either invest in the majors, but then you've got sort of a lower probability of outperformance, or you can try your hand at trying to pick which junior mining company is going to bring their projects in on time and on budget. But that's a very challenging task. Whereas a royalty gives you the style of exposure that I described from a diversified portfolio. As you saw on the map, we're spread across multiple operators, multiple jurisdictions, and then obviously multiple commodities. So it's a way to get your exposure to the sector, almost an index fund-like exposure through multiple assets within the portfolio, but still get that outperformance that can be driven at the asset level relative to buying majors or index funds. Just given the time, I won't spend too much time on lithium. Obviously, it's a big driver within our portfolio. The portfolio is obviously going to evolve as we continue to acquire assets. The commodity mix is going to shift and move. We want to get to the point where we're broadly representative of the entirety of the sector. We do like lithium. One of the key reasons is when you look at all the key battery technologies, lithium, which is the dark blue, is a component of all of them. So you hear nickel companies pitching nickel chemistries, cobalt pitching cobalt chemistries. Lithium's a pretty solid, consistent across the board. Sodium ion, which is not on the list, has the potential to disrupt for short distance sort of commuter vehicles in China. I don't think we're going to see that emerge materially in places like the US and the UK. Nevertheless, I think the broader trend of the fact that less than 8% of US auto sales last quarter were EVs, the administration's targeting 50% by 2030. We're talking millions and millions of vehicles. Now, undoubtedly, I think those targets are going to slip. The UK also has pretty aggressive targets, but the trend is pretty undeniable. And that's only specific to EVs. I was reading today about the Sunstream project in Arizona, which is a solar project. It's not unique. It services about 300,000 homes in Phoenix. That requires the equivalent of 40,000 EVs with regards to battery capacity. That can only be a lithium ion because of the energy density. You can't replace that with sodium ion. And then some of the potential upside in the solid state batteries, which Toyota's been pushing, that actually requires more lithium than the current lithium ion batteries. So in terms of getting exposure to this greenification of the economy, we think lithium is one of the better commodities to get exposure to. And then I'll just touch on, I won't drag you through the 21 assets within our portfolio, but I'll touch on a couple of them. One is Thacker Pass. I'll do that one because it's the largest asset within our portfolio from a NAV perspective, and it's also a good representation of an existing royalty that we've acquired. So that we didn't write this royalty, it was in existence. So we bought this royalty from a private equity fund. They wrote the royalty back in 2011. So two things have changed over that period of time. One is lithium has emerged as a pretty critical commodity. The second is the project itself, Thacker Pass, went from exploration stage to now in construction. So this royalty increased exponentially in value. When we acquired it, it was off the back of the operator, Lithium Americas, getting their final key federal permit for construction. That same week that they received their permit, they raised $400 million in equity towards construction. So we secured the royalty off the back of that news. We knew of its existence, obviously predating that, but that was the catalyst for us. When we bought it, we priced in about a 16% post-tax IRR, so a 16% return effectively year after year for a 40-year mine life. And the resource is 4 times the size of the reserve, so ample scope for that mine life to extend or for the production profile to grow. And in fact, the production profile did increase after we acquired the royalty, which is a benefit for us as the royalty holder. As I said, we can't be diluted. We get, in this case, 1.05% of their revenue. That's fixed. The royalty's over the property. The operator could go bankrupt, and the royalty is there in perpetuity. It doesn't go away. So when they increased the planned production profile, that bumped our base case IRR from 16% to circa 20% on a post-tax basis. The other element is lithium. At the time, we were pricing in a long-term price of $12,000 per ton. It obviously skyrocketed last year, hit $80,000 per ton, came back down to earth, and is at about $20,000 a ton today. The long-term consensus price, though, is $21,000 a ton. So again, a pretty healthy uplift from the $12,000 a ton we were pricing in. And I should mention on that expansion, one of the reasons we like royalties is their capex to build the project went from $550 million to $2.3 billion. Obviously, a lot of that's driven by inflation, but part of it's driven by the fact that it's now a bigger project. Again, that's not our capex ticket to write. We get the benefit of the upsize in production. We get our fixed 1%. So the bigger the project gets, the happier we are. And incidentally, with lithium being a non-exchange traded commodity, you will get these years where it significantly outperforms, like last year. In a year like that, it would have paid us circa $60-70 million for the year. At current spot prices, once fully ramped up, it would be paying us about $21 million a year, as I mentioned, for multiple decades. The project is a tier 1 project, globally significant. The biggest shareholder of the operator is General Motors, who also has the lithium offtake to produce up to 1 million EVs per year. So it's the kind of asset that we want to get into the portfolio and really underscores the strategy. This is a lithium mine in Nevada. If it was a gold mine in Nevada, we'd be combating the other 20-plus gold royalty companies to try to secure a royalty like this. But us being a diversified royalty company, you can count on one hand the number of parties chasing these assets. And so just given the time, I'll jump ahead to our balance sheet, because obviously a key focus of our company is to try to manage our share capital and our cash balance effectively, to try to secure as many royalties as we can. As of printing this presentation, we had $25 million in cash and $40 million in debt outstanding. We made a copper acquisition earlier this month, so we now have sort of $18-19 million in cash. Importantly for us today, we actually announced a new debt facility with BMO and CIBC, two good big Canadian commercial banks. So it's for the $40 million that we previously had. The big difference is twofold. One, it's at a much lower coupon, so we pay 2.5 to 4.5% over SOFR, whereas the previous facility was much more expensive. So this gives us about as low a cost of capital as you can get in our sector. The other aspect is it's a revolving credit facility. So whereas the previous facility had to be fully drawn, the full $40 million, and therefore you're paying interest on the full $40 million despite sitting on the cash balance. With a revolver, you can draw it down, pay it back, draw it down, pay it back, and you just pay a smaller percentage of a standby fee on the undrawn portion. So it lowers our cost of debt, which has come at a time that's pretty critical for us. As I said, it's a good time in the market when most equity prices are under pressure. Mining companies are in need of financing. They want to continue to move their projects forward. They don't want to go to the equity markets to raise capital. So they're open to royalty financing, and that happens to coincide with a period where we're pushing down our cost of capital. So not only can we push our returns with regards to the deals that we're acquiring, we're doing so at a lower cost of capital. So the spread of return has increased significantly for us. The final thing I'll mention as I'm on my last minute is we've got a strong shareholder register. When we first listed, it was heavily weighted towards resource and mining-focused funds. We've evolved that over time, brought in the likes of Ruffer in September as a major shareholder, Amati, BlackRock. So good UK institutions that like what we're doing and are supportive, and I think will be critical for us going forward as we look to continue to grow the business. So with that, I'll pivot to any questions.
Adam, thank you very much. Okay, so questions, please. Sorry, we've got a couple down the front here. I've got my microphone. Give me a second. Let's start, please. Thank you.
Hi, I see you've got something in Mali,
yeah.
And Africa's sort of changing in the moment because the coups and they're actually trying to take control back of their resource. Does that come into your thinking at all?
Yeah, definitely, 100%. I think, so this asset is over the Dandoko property, which you can kind of see there circled in red. I think for us to go into Mali, we needed to have an operator that's tier one and can navigate these sorts of situations. So in this particular case, the asset is owned by B2 Gold, so a good $4 billion market cap company. They operate the Fekola mine, which is in the lower left of this map. It's, I think, the second largest mine in Mali, and I think the third largest mine in Africa in its entirety. Produces 600,000 ounces a year at $600 all-in cost per ounce in an environment where gold is at 2,000 plus an ounce. So spits out a ton of cash. It's an important asset to Mali. B2 Gold is flagged that, and you can see the little line between the two, that they see near-term scope within the next sort of 12 to 18 months to truck material from our property and put it through their Fekola mill. It's got spare capacity, and our property's a higher gold grade. And then they've said longer term that our property and another satellite property could comprise its own standalone mill, which would be quite a bit of upside to us. So to answer your question more directly, we do look further afield. We do take these factors into consideration. Jurisdictional risk is very real in the mining sector, and we have to price that into our returns, most importantly. So a gold, even a quality project like Fekola or property like Fekola, we still need much higher returns than, say, a commensurate gold project in Australia.
Thank you. All right. Thank you.
I find myself accidentally an investor in your company in a small way through holding Amati and BlackRock. So I have a particular interest in trying to draw a few strands together. Your market capitalisation at the moment is about 93 million or thereabouts, from what I read. And mining generally is a business that I don't particularly understand, so I have to really have faith in the people who are doing it and feel that they have faith in themselves as well. If I look at the shareholding of the board, between you, you're holding about 12 million shares at a value of about 4 million. So in effect, you're holding about 5 or 6% of the company, which is a degree of exposure, but not a heavy degree. I note that personally, you, according to the 2022 accounts, and the circumstances may have changed since, you're holding 300,000 shares, which, broadly speaking, is somewhere around 90,000. And that's about the average size of an investment that I would make in a business. But on the other hand, I'm not drawing a salary of $650,000 from the business. And I feel slight unease that if you're not buying the shares at this point in time, why should I?
Yeah, sure. Yeah, it's a fair question. I think a couple of aspects. I don't think anybody that came into Trident came into it sort of in a wealthy position. All the shares I've acquired, I've bought on market in the last few years. So I may have bought 70,000 worth of shares just this year alone, and obviously intend to continue to do so. The bulk of our exposure is via options, and I think this might go some way to give you comfort in that the bulk of our options are priced at a strike price of 50p, so above where we are today, and then vesting conditions of 80p to £1.20 in 10p increments. So we've got to hit those levels, hold the share price there for a defined period of time before they vest. Obviously, when they vest at those levels, they'll be above the 50p target. But that's really our incentive, so very much aligned with shareholders in that regard.
Just one subsidiary thing which confused me slightly is that I had the pleasure of having a brief conversation with a non-executive director of your company recently appointed from a Canadian bank, I understand. And I asked her what her share exposure was, to be told that part of the deal that she had involved not being able to acquire shares in the company. And that struck me as being unusual because in this country, often, not always, non-executive directors are expected to invest 3 times their salary in the company to which they're providing a service by way of alignment with shareholders' exposure. And to have a circumstance, I am told, in which this lady isn't allowed to acquire shares just struck me as being interesting.
I think something must have been lost in translation there because our directors can certainly hold shares. We find ourselves often in closed periods because when we make acquisitions, obviously we can't front run the market, so we're blacked out a lot of the time, but we can buy shares. In fact, our chairman holds 7 million shares, again, all shares that he's bought in placements or on market, so not sort of freely issued shares. So no, everybody's well committed in that regard.
Other questions for Adam, please? I've got one. Just one moment. My one. About diversification, I think in total between lithium and gold, you're around 73%. Are you satisfied with the level of diversification, or are you looking to further diversify?
Yeah, the intent is definitely to further diversify. I think we've probably become, we've secured more gold royalties than we initially expected, just given the level of competition in the gold royalty space. In fact, earlier this year, we monetized a few gold exploration royalties. We sold them to one of our bigger peers. We'd acquired them 2 years ago for $6.25 million and sold them for $15.5 million. For us, that's a much cheaper form of financing to recycle that capital on assets that are long dated and have probably slipped with regards to their timing. So we saw an arbitrage there to bring some capital into the business. So from our perspective, we'll pick up gold royalties when and where we can find value. Assets like Dandoko, that was a bilateral negotiation with the royalty holder that we bought the royalty off of. If it's a competitive process with the 20-plus gold royalty companies, we don't participate in those. So I think long-winded way of saying we'll snag gold when and where we can, but by and large, we want to continue to broaden the non-precious side of the portfolio, add nickel, add some zinc, add to more copper to the portfolio, those sorts of things.
Hi there. I know nothing about your company, but could you tell me about some failed or delayed projects or delayed assets and talk about the quantity you have and the impact that's had on the business?
Yeah, sure. That's a good question because it's easy to talk about your winners. I think, flip to the asset map, we haven't had anything go too seriously sideways yet, but a good example of one would be an asset operated by Silver Lake, which is in Canada, the Sugar Zone mine. When we picked this one up, it was producing and cash flowing, and then in about July this year, the operator ceased production and announced that they wanted to invest $40 million into the project, putting in almost 100,000 meters of drilling and effectively kind of redesign the mine. So it's a sort of a good news and a bad news story. We think it'll come back out the back end of this in a much stronger position. But in terms of nearness of cash flow, that obviously delays things. They expect to reopen it in 2024. So these things aren't uncommon. Even a good news story like Thacker Pass, I think we probably expect, us and the entirety of the market, expected it to commence construction sooner than it has. It started construction. They're putting $145 million into it in the back half of this year, and that'll accelerate next year. First cash flow is expected in H2 of 2026. But when we originally acquired the royalty in 2021, we did have it modeled to be sooner.
Question back here?
Hi, do you have any views on why the share price has dropped so dramatically recently?
Yeah, I think probably the biggest reason, without putting too fine a point on it, is you'll see Orion Mine Finance is no longer on the major shareholder list and had filed a couple TR1s over the last couple months. They were nearly 10% of our register. They're a PE fund, so they are probably the most prolific generator of royalties in our sector, and we bought royalties from them. When we did so, it's usually predominantly in cash, but then we'll also use some scrip. So they were a shareholder and then had a need to exit in a hurry. And this is not the kind of market to facilitate that kind of exit. So we've worn some pain over the last really just the last 2 months. You can see we've dipped quite a bit from a peak earlier this year of sort of near to 60p. We feel like it's a combination of that as well as just more broadly institutional investors have had redemptions. I think by and large we've seen that start to ease off and largely cease. But yeah, it's a symptom, I think, of the market that we're in.
Another question at the back, please. Yep.
Hello. You mentioned on the subject of diversification, I noticed that you've got silver, but it figures lower on your holdings. And I'm curious because silver is a precious metal, but it's also used in production. And your slide mentions there that it's got a green use in terms of solar panels, which might be a future growth business. So is there an aspiration to increase your holding in silver?
Yeah, I think as a company, we're pretty bullish on silver fundamentally. Actually, in the particular asset that we acquired earlier this year, they've got an operating mine, and then we've got a royalty over a property that they expect to put into production in the second half of next year. They're going to start trucking material through open capacity that they've got in their current mill. And all their current silver production goes to Samsung, so it's used in electronics. So yeah, the short answer is we do like silver.